I'm Liam Price-Jones, Head of the South at Brooks Macdonald, and I'm pleased to welcome you to an investment outlook update with my colleagues in the region. And I'm joined by Todd Sejan-Ellis, Investment Director based in our Southampton office, and Isabel Gingell, based in our East Anglia office. And first of all, Todd, I'd just like to ask you, in terms of the markets this year, can you just give us a brief overview? What's the difference this year between last year?
Absolutely. I think markets over the last couple of years have been categorized by really rapid shifts in terms of styles and what the market favors in general. So coming up to the end of 2021, we started seeing high inflation come through, which led to high interest rate expectations. 2022 meant that year was really led by certain sectors like oil and gas producers, banks, areas which we call value. Those companies were performing really, really well, predominantly because energy prices were high, so oil and gas producers were making really good profits. Banks were expanding their margins as interest rates were going up, and that's effectively what categorized last year. Now, this year we've seen a bit of a shift as interest rate expectations are hopefully coming down. Hopefully we're seeing the peak of interest rates now, and we have seen companies within the growth part of the market perform really well. I'm talking about things like the Magnificent Seven companies in the US, and the perfect example would be a company like Meta, which is the owner of social media companies like Facebook, Instagram, WhatsApp. I mean, Meta performance last year was down about 60% in 2022, and so far this year it's up almost 200%. So it erased completely all the losses of last year, come back fully to where it was now, which means that effectively what we have to make sure to do is diversify client portfolios across these two different investment styles, because that kind of change of leadership is very quick.
So you would say that it's been a good year to have balance within portfolios?
Absolutely. Something that has done well last year hasn't necessarily done well this year, in order to make sure that we participate both in the upside and also protect client portfolio values on the downside. We need to make sure that there's good diversification and a good balance between these two different investment styles.
Thank you. And Isabel, what are you seeing in terms of the challenges that clients and advisors are facing this year, and how have you addressed them?
In markets where the winners and losers can whipsaw so quickly of what we've seen this year, and coming off the back of 2022, where it was one of the worst years in a generation, clients who are taking income from their portfolio have really struggled with some of the inherent risks that come with that. So sequencing risk as an example. What that really means is the order of returns and when you're taking an income. So for instance, if you've had a portfolio which has performed quite badly or been negative in terms of returns, and you're taking an income from that, you've almost got two hurdles to try and overcome to get back where you started. So having that as a challenge this year, where we've had areas of the market change rapidly in terms of outperforming and underperforming, being able to mitigate some of those risks has been one of the challenges that we've faced this year.
And how have you done that within portfolios? What instruments or what investments have you used to try and achieve that?
Equity returns can be really volatile for the short term. So if we look at your UK equity returns, for example, they can have a fabulous year where they could be up 30% or they could be down 30% in 1 year. When you look at it over the longer term, those returns tend to average out over time. So what we're looking at is, in any short-term environment where we're taking income, we want to protect the portfolio as best we can. So where we look at investing in areas of the market for income in the short term, for us that's around 7 years, we're using what's called a defined return investment, also known as a structured product. So those types of investments help secure income for the short term, so that if we do continue to have volatility in markets, which seems likely in the fact that we're still looking at where inflation is heading and interest rates, we want to make sure that clients who are taking an income are protected as best they can. Bucketing portfolios, so having elements of cash, gilts, structured products for the short term, so that we can leave equities for the longer term, which tend to outperform those other asset classes over a longer period of time.
Thank you. So we've got a number of options, but Todd, what are you seeing with interest rates so high? Obviously, clients have been turning to cash. What have you been doing there about that, and what sort of conversations have you been having with advisors and clients?
Well, cash has really come back as a genuine competitor for investments and for diversified portfolios. My one comment would be that actually market does provide other instruments that actually can outperform cash. And we've run numerous equity market studies which show that in general, diversified portfolio of equities and bonds outperforms cash over pretty much every longer term time period. However, for the shorter term, I think the UK gilt market offers a really good opportunity. So UK gilts is effectively UK government debt, which is seen as a risk-free investment. Now, at this moment in time, short-dated gilts are yielding, which effectively means annual returns, anything between 4.3 to maybe 4.7% over the shorter term. Now, the really key benefit of that gilt investment is any capital gain on gilt is tax-free. Now, gilts pay coupons. We'll try to select very short-dated gilts, which pay very low coupons, which means that actually most of the return is coming from capital appreciation. Now, the best thing about it is that capital appreciation is tax-free. So an investor who, let's say, is a 40% taxpayer would have to get an equivalent interest rate at a local bank of about 7 to 8% in order to match the same level of return from gilts. That's why I think buying a diversified short-term gilt portfolio is a really good alternative to actually cash investment. Another benefit of that is that it's fully tradable and fully liquid in the secondary market. So you don't have to lock up your capital for any certain period of time. You can always liquidate it and reinvest money back in the markets when some confidence has returned.
So often we see clients at times of market volatility getting quite anxious and coming out of the market. What do you see as the outlook, the positive outlook going into 2024? Why should clients remain invested?
It's really interesting when you look at market returns and actually the spread of the best years and the worst years. They tend to be clustered together. So if you look back to the financial crisis, some equity markets in 2008 were down 30%. Following in 2009, those markets were up 30%. We saw that again, with COVID, 2021, growth and tech stocks really pulled the markets higher. We had a great year. And then in 2022, equities and bonds both fell by around 20% each. So you can have a lot of good and highs and lows with investing that seem to cluster around a few years together. What we've looked at in certain market situations and how inflation and interest rates affect markets. If you think about the US, generally speaking, when inflation and interest rates are 5% and looking like they're falling, like the conditions we're seeing at the moment, US equities seem to outperform those markets 63% of the time. If you then look at inflation being 5% or under 5% and falling, US equities outperform over 80% of the time. So we're starting to see some positive signs that inflation is starting to recede, and markets are all looking at the central banks to see what's going to happen and when they're going to start cutting interest rates. So we think that when those sorts of positive influences come back into the market, there is a really good chance that you can see some really positive returns come back into the market and positive sentiment too. So it's all about staying patient with time horizons on your side. If you've got a long-term time horizon, then equities will outperform cash and bonds over those time periods. But it's making sure that you stay balanced, diversified, and patient through those rocky periods.
So Todd, going into 2024, what do you see as potential challenges in the year ahead?
Having seen so much volatility over the last couple of years, I think it's extremely important that we position our client portfolios appropriately for what might happen. I think we have seen peak inflation. Inflation is on its way down. Interest rates will hopefully start coming down at some point in next year too. And I think if that was to be the case, we need to make sure that we expose our client portfolios to areas that could grow better than the market when things start normalizing. Now, of course, that comes with certain risks. That there's no guarantee that inflation will keep falling or interest rates will start falling. So in that case, we need to make sure that we still have healthy exposure in our client portfolios to areas that protect better against any potential further increases in inflation, which is, again, sort of those value stocks that I mentioned, like banks, oil and gas producers, anything that's a little bit more defensive and is making good money now and doesn't depend on interest rates being low in order to operate well. Now, I certainly believe that there are other things driving the market too. I mean, UK general election coming up next year will be extremely important. I think generically speaking, it's very difficult to predict what the outcome might be. But I also think, regardless of what outcome might be, the city in general feels a bit more optimistic about any potential Labour government. Labour leadership these days is much more business friendly and market friendly than it has been over the last few years. And I think that's what's really positive and encouraging for the city and markets more broadly. Of course, geopolitical risks are always at the top of the agenda as well. Just to reiterate, I think we need to make sure that our client portfolios are well diversified, have exposure both to those defensive assets that would protect them in the downside, but also have exposure to growth parts of the market, which will actually perform really well if things are a bit more normal and some sort of growth continues.
So geographically, going into 2024, are there areas of the market or areas of the world that you would see us position our portfolios towards?
We're keeping an eye on the general market because at present it looks like corporate earnings are remaining resilient. Consumer spending is also stable. Wage increases are still around, and also the oil price. Unfortunately, we've seen war in the Middle East recently, so whether that impacts that area of the market is yet to be seen. But in terms of client portfolios, we are still remaining balanced because the picture for inflation and interest rates is still not yet decided. There are areas of the market which have been unloved because of higher inflation and interest rates, such as small and mid-sized companies who generally are seen to potentially not be able to deal with high levels of interest rate on debt that they may have on the balance sheet. So if we start to see interest rates come back in 2024, those areas of the market may become more favourable, and there may also be more value to be had in holding those parts of the market, for instance, in the UK and in the US. So it's something that we're definitely keeping an eye on, but we are remaining cautious in terms of going into those areas and whether we feel like it's too soon just yet.
Thank you, Izzy. And from our point of view, I think in summary, it feels that we feel a lot more optimistic about the outlook for 2024, especially where we've come from. So if we see inflation having peaked and interest rates beginning to slow down, then I think the outlook is much better. Thank you very much indeed for watching. We intend to do this on a regular basis if we can, and we'd be very grateful for your feedback. But if you have any questions from this video, or you want to get in touch with the investment team, then please do so. Thank you very much indeed for watching.